If you are retired right now, or you are standing on the absolute edge of retirement looking out into the next 20 or 30 years, I need you to drop whatever you are doing and pay close attention. We need to have a serious, unfiltered reality check about your money. You have spent 40 years working hard. You skipped the vacations, you saved, you sacrificed, and you watched your 401k or your IRA grow. You think you did everything right, and you're feeling pretty good about it. But I am here to tell you that there is a silent, invisible thief waiting for you in retirement, and it is going to take a massive bite out of your hard-earned cash if you do not wake up right now. That thief is taxes. Most people walk into my office or write to me, and they say, "Susie, I'm retired now. My income is lower, so my taxes are going to disappear." Wrong. That is the single biggest, most dangerous lie you can tell yourself. The truth is, how you pay taxes changes completely the moment you stop collecting a paycheck. And if you don't understand the rules of this new game, you are going to lose a fortune that you cannot afford to replace. Let's talk about the absolute fear that keeps so many of you awake at 2 o'clock in the morning. The fear of running out of money. You look at your nest egg, and you think it's yours. If you have $1 million in a traditional 401k or a traditional IRA, I hate to break it to you, but you do not have $1 million. You have a joint account with Uncle Sam, and he gets to decide his share whenever you take $1 out. Every single withdrawal from those accounts is taxed as ordinary income. That means the IRS treats your retirement savings just like a regular old job. And then comes the question everyone asks me, "Susie, when do I actually have to start taking this money out?" The government forces your hand. They have something called required minimum distributions, or RMDs. Once you hit age 73 or 75, depending on your birth year, the IRS says, "Time's up. You must take this money out whether you need it or not, and you must pay taxes on it. If you don't, the penalty used to be 50%, and even though it's lower now, it will still absolutely crush you. If you don't plan for RMDs, they can push you into a much higher tax bracket, which triggers a domino effect that destroys the rest of your financial plan. Have you even thought about your Social Security? This blows people's minds. You think Social Security is tax-free because you already paid into it your whole life. No, it is not. If your total income, which includes half of your Social Security plus your other retirement income, goes over a measly $25,000 for an individual or $32,000 for a married couple, up to 85% of your Social Security benefits become taxable. Think about that. You are being taxed on the money you saved, which triggers a tax on the money the government is giving you back. It is a tax torpedo, and it is sinking the retirements of millions of Americans who didn't see it coming. And it gets worse. If your income jumps because of forced RMDs or poorly planned withdrawals, you hit the Medicare premium surcharge, known as IRMAA. Suddenly, your monthly healthcare costs double or triple just because you took too much money out of your own account in a single year. You are being penalized for being successful, all because you didn't have a strategy. So, what are you going to do about it? Are you just going to sit there and let the government dictate how much of your wealth you get to keep? No! You need to take control of your destiny right now. Here is your first actionable takeaway: you must understand tax diversification. You cannot keep all your eggs in the traditional, tax-deferred basket. You need money in 3 different buckets. Bucket number 1 is taxable, like your regular savings or brokerage accounts. Bucket number 2 is tax-deferred, like your traditional IRA. And bucket number 3, the holy grail, is tax-free, which means a Roth IRA. If you are still working, or if you are in the early years of retirement before your RMDs kick in, you need to look at Roth conversions. This means you voluntarily take money out of your traditional IRA right now, you pay the taxes on it today at today's known tax rates, and you move it into a Roth IRA. Why would you do that? Because once that money is inside the Roth, it grows tax-free, and when you take it out in your 80s or 90s, it is 100% tax-free. No RMDs. No impact on your Social Security taxation. No Medicare surcharges. You are locking in your tax rate today because let me tell you a secret, tax rates are historically low right now, and they are likely going up in the future. Pay the tax now to protect your future self. Your second takeaway is to watch your withdrawal sequencing. Stop just pulling money randomly from whatever account looks biggest. You need a deliberate plan. Generally, you want to draw down your taxable brokerage accounts first, letting your tax-advantaged accounts grow as long as possible. But you also want to fill up your current lower tax brackets every single year by strategically converting traditional IRA funds to Roth funds up to the top of your current bracket. Do not leave a low tax bracket empty. If you are in the 12% bracket, fill it up to the max with conversions before the brackets potentially reset higher. Listen to me, your financial advisor might be great at helping you invest, but investing is only half the battle. If they are not talking to you about a proactive, multi-year retirement tax plan, they are failing you. You need to sit down with a certified public accountant or a tax strategist who specializes in retirement. Ask them specifically, how do we minimize my lifetime tax bill, not just my tax bill for this year? Do not wait until you are 73 and the IRS sends you a bill that breaks your heart. The money you save by planning today is the money that ensures you can stay in your home, afford your health care, and live your retirement with the peace of mind, dignity, and security that you earned. You have the power to protect your wealth. Now stand up, take action, and protect it.